Hey there, and welcome to This Explainer. Today, we're going to break down one of the absolute most practical, effective, and honestly powerful concepts in modern investing. Whether you are a complete beginner just trying to figure out what to do with your savings, or maybe you're someone who just wants a much clearer picture of how the financial world actually operates, you are in the exact right place. So let's dive right in and demystify ETFs.
Okay, let's start by painting a picture that I think pretty much all of us can relate to. Imagine you decide it's finally time. You're going to start investing. You download a stock market app, you open it up, and bam, you are immediately faced with literally thousands of choices. You've got massive technology companies, giant global banks, healthcare startups, energy businesses, massive retail chains. The list goes on and on. And suddenly, this seemingly simple desire to just invest your money becomes a surprisingly difficult, almost paralyzing question. Which stock should you actually buy?
And, it actually gets worse, right? Because even if you do your research and you find one company you really, really like, this next question inevitably creeps into the back of your mind. What happens if I'm wrong? What if the company struggles? What if the entire industry changes completely overnight, or a new competitor just comes in and takes over? For a lot of people, this is exactly where investing becomes completely overwhelming. You know that leaving money in a regular bank account means it grows incredibly slowly. And you know owning productive businesses is how you actually build long-term wealth. But putting your hard-earned money into just one or two individual businesses, that just feels way too complicated and honestly, way too risky.
So, to solve this headache, we are going to follow a really clear roadmap today. First, we'll look at the stock picking problem. Second, what is an ETF? Third, the power of diversification. Fourth, how do ETFs work? Fifth, we'll cover risks and misconceptions. And finally, building long-term wealth.
All right, step one, the stock picking problem, or as it's often called, the paradox of choice. Moving right along to step two, what is an ETF? The simple solution. Today, literally trillions of dollars are invested through these specific vehicles by total beginners and Wall Street professionals alike. ETF stands for Exchange Traded Fund. Now I know, the name sounds incredibly dry and highly technical, but the core concept is actually brilliantly simple. Just think about a basket. Inside that basket, someone has placed a whole bunch of different investments, maybe dozens or even hundreds of different companies. Instead of going to the market and buying every single one of those items individually, you simply buy the basket. When you purchase just one share of an ETF, you instantly get a tiny ownership stake in absolutely everything inside that basket. Okay, step three, the power of diversification, which is really just a fancy way of saying spreading your risk. Let's compare two different investors to really understand why this matters so much. Investor A decides to buy into a single famous technology company. Everything about their financial future now depends entirely on that one specific company. If it fails, they lose a massive chunk of their money. Now, look at Investor B. Investor B buys an ETF. By owning the basket, they've instantly spread their money out across multiple slices of the entire economy. They get a slice of technology, a slice of healthcare, some banks, some energy, and retail. For Investor B, one single company failing matters a whole lot less because it's just a tiny drop in the bucket. This is diversification in action. Rather than trying to predict the future and pick that one winning startup, successful investors use ETFs to simply own a broad collection of everything. Which brings us to step four. How do ETFs actually work? Let's peek at the mechanics behind the basket. So, if you're buying a basket of hundreds of companies with literally just one tap on your screen, what is actually happening behind the scenes? Well, it works in three pretty straightforward steps. First, an organization known as a fund provider goes out and purchases the underlying investments. So let's say they buy shares in 500 different top companies. Second, the provider places all those actual shares into a fund. That's our metaphorical basket. Third, they offer shares of that fund to everyday investors on a stock exchange. When you log into your brokerage account and buy a share, the value of your ETF is going to perfectly mirror what's inside of it. If the investments inside the basket go up in value, your ETF goes up. If they fall, your ETF falls. It trades all day long on the exchange, exactly like a regular single stock. And honestly, that explains why they are so incredibly popular right now. It really rests on five main pillars. Diversification, because you're spreading out your risk. Convenience, since you get broad exposure with just one single transaction. Accessibility, which allows everyday people to build these huge, diversified portfolios without needing millions of dollars to start. Transparency, meaning you can look up exactly what your basket holds on any given day. And finally, low cost. Because a lot of ETFs just automatically track a preset list of companies, their operating costs are super low. And trust me, over decades, paying lower fees has a massive, massive impact on how much of your wealth you actually get to keep. Now, that low cost we just talked about, it's heavily tied to the difference between active and passive investing. Active investing is when highly paid fund managers research, predict, and actively try to pick specific winning stocks to beat the market averages. Passive investing, on the other hand, takes a totally different approach. It doesn't even try to beat the market, it just tries to match it. Passive investors do this by buying index ETFs, which are baskets that simply own all the companies in a specific market index. They aren't trying to guess the winners and losers, they just own the entire collection. It completely removes the guesswork.
All right, time for a reality check. Step 5, risks and misconceptions. Let's debunk a few common myths.
It is a very common misconception that ETFs are this guaranteed, magical, risk-free ticket to endless profits. They absolutely are not. ETFs reduce company risk, but they do not eliminate market risk. And let me explain the difference because it's absolutely crucial. If an ETF holds 500 companies and one of those companies goes completely bankrupt, your ETF is largely going to be fine. That's company risk being eliminated. But if the entire global economy enters a severe recession and the whole stock market declines, your ETF is going to lose value too. You are protected from a single bad business, but you are not immune to a bad economy.
Oh, and a real quick, another big misconception is how they compare to mutual funds, mostly because the two get confused all the time. Both pool money together to buy a diversified basket of assets, but the absolute biggest difference is how they trade. ETFs trade continuously on the stock exchange throughout the day. The prices are changing second by second while the market is open. Mutual funds, however, are typically priced just once per day, right after the markets close. Honestly, neither is universally better than the other. It really just depends on whether you prefer having that flexibility to trade during the day.
And that brings us to step 6, building long-term wealth. This is the ultimate goal. You see, smart investors do not use broad ETFs to try and get rich quick. No way. They use them as foundational building blocks for long-term financial independence, for their retirement, or maybe for securing their children's future. Think about the timeline. In year 1, the goal isn't huge profits. The goal is simply to invest consistently. Over 10 years, you just allow those diversified investments to grow as the global economy expands. And by year 20 and beyond, that is when you unlock one of the most powerful forces in all of finance, compounding. Your investment gains actually begin generating their own additional gains. It's literally like a snowball rolling down a hill, getting bigger and bigger, making ETFs incredibly practical long-term wealth-building tools. But here's the thing you have to remember. Ultimately, the success of an ETF doesn't come from the ETF itself. The ETF is just a container. It's just the basket. What truly dictates your success is your behavior as an investor. If you panic and sell everything during a sudden market downturn, or if you're constantly chasing the newest, hottest trend, you are going to struggle. But investors who focus on long-term discipline, they tend to perform incredibly well. ETFs brilliantly simplify the mechanics of investing, for sure, but they absolutely cannot replace your patience, your discipline, and your ability to just keep your expectations realistic. ETFs completely transformed investing. They took something that used to be incredibly intimidating and turned it into something simple, accessible, and achievable for ordinary people all over the world. But now that you understand the mechanics of the basket itself, there's a really fascinating next step. What exactly should go inside that basket to maximize your chances of success, especially without paying high fees to a manager? Well, the answer to that lies in the incredible world of index investing. So, now that you've mastered the structure, are you ready to learn exactly how to fill it? We'll tackle that next time. Thank you so much for joining me on this explainer, and keep learning.